Hello, this is Merle Dimbath, the concheconomist, presenting again today another series in our presentations on buying a home in 2026. Primarily geared toward first-time home buyers, but even if you're buying your second or third or fourth home, we think that these presentations will be of help to you. Today, we're going to get into some very specifics on how to make an offer. What should you consider? What are some guidelines to develop in order to make an offer? You don't want to pay too much. And so let's get right into it. We'll begin by using an example taken from Zillow of a 4-bedroom, 2-bath home, and the asking price now is $389,000. There's some points right here up in front that can give us a guide as to what we should estimate for what we should make as an offer. For example, Zillow has an estimate here of $379,000, so that's about $10,000 less than what's asking. So that would be a good starting point. Another thing to look at is the square foot figure here of $206. You could compare that with other properties in the neighborhood and see how that compares. That 206 is developed by dividing the asking price of $389,000 by the square footage of 1886. There are a couple of other points that we can make here. First of all, there's no HOA, and that's a positive. We want to avoid that if at all possible. A negative is the fact that it's a relatively old house built in 1972, and that could be negative for insurance premiums. So before you make an offer on any property, make sure you check with your insurance carrier and find out what that property will cost from an insurance point of view. A positive point here is that it does have a fairly good sized lot here of 1/3 of an acre. Moving on down the page of the listing, we can see that it was just recently listed in February, so it hasn't been on the market very long, and this may be negative in terms of making a really good low offer. So if you're interested in a property like this, watch it for a while, see if there's been any price drops, and then make your offer, because you can sometimes get your better deals after a property's been on the market for a while. On a positive note, it is empty, so the the owner is having to pay expenses each month. One thing that's interesting to point out is that if we look and see what did this property sell for originally, or well, not originally, but back in 2014, $175,000. So they're really trying to add a lot of dollars to the asking price here. We'll look at that in a few moments and see whether or not that's a realistic assumption. Looking at another example, this one also from Zillow. We have a 3-bedroom, 2-bath house, a little bit larger, 2,035 square feet, a little higher price asking here, $405,900. Now, it is interesting to point out that there was a price cut recently of $10,000. This is positive. And we can see here that the Zillow estimate is right at $400,000, so that would be a good suggestion for an offer. Also, you can always go in and make an offer of 10% less than the existing asking price, because it's always good to see what the seller will respond to. In fact, one of the questions you should ask the listing agent, and I assume that you're working with the listing agent, is why are they selling? This indicates motivation. And also, have they turned down any offers? You'll get some idea of how if there's been any serious interest in the property. This can also influence motivation on the part of the seller. Other things here, besides the Zillow estimate of $400,000, we can see that it was built in 2005. Now, this is positive because this should mean maybe a better rate on insurance. A newer home very often gets a better rate than an older home. Unfortunately, this has an HOA of $35 a month. That's not exorbitant. A lot of HOAs are much higher than that, but just remember, every dollar that you spend on an HOA is a dollar less that you have to spend on a mortgage. The size of the lot here is good also, about 1/3 of an acre. Going on down the page of this listing, we can see that there have been some price reductions. As we indicated earlier, it was originally listed for sale at $424, then they dropped it to $415, now it's at $405. So obviously we have a motivated seller here, and as we can see from some of the pictures of the property, the rooms are empty. So this is another empty house, which is always a motivating factor. Another thing to point out here, and we're going to talk about this just in a moment, this house sold in 2005 for $183,300. So their asking price today is more than twice what they paid for it. So obviously there's room to come down here. We don't know we don't know here what the mortgage on the property, on the existing mortgage is. But speaking of mortgages, I've indicated earlier that you should try to get pre-qualified so you can be a very strong buyer. And another way to develop a offer is to get the property appraised. Now, we don't want to do this unless we're really serious about the property, because appraisals cost money. But the lender is going to require an appraisal to make the loan. The lender will make a loan based upon the lower of either appraised price or contract price. So since you're going to have an appraisal anyway, if you're really, really serious about a property and you're in doubt as to how much to offer, you might go ahead and pay for an appraisal. It will cost a few $100s, but you're going to have to pay it for the mortgage anyway. Check with your lender. Make sure that you use an appraiser that they approve of. You can't just get any appraiser. When you go in to your lender, and I urge you to shop around to 2 or 3 lenders, find out what their charges are, their interest rate, their closing costs, etc. But find out what appraisers they approve of, and find out how old the appraisal can be. For example, is it okay if the appraisal was made 90 days ago or 60 days ago? Find out how old that appraisal has to be. But sometimes it's worthwhile to get an appraisal on a property, since you're going to have to do it anyway to get the mortgage. Another factor to consider in developing your offer for a property is inflation. Just how much would you expect inflation to impact the price of the house, or the asking price of the house, since it was last purchased? You can look at the information on Realtor.com or information such as Zillow, and you can see what was the price of the last purchase of the property and what was the year. And by comparing the price in the previous year when it was last sold to the CPI expected here in 2026, we can develop an estimate of, or a ratio of what we would expect the price to have adjusted just based on inflation. Using 2025 CPI annual rate of 321.943 as a beginning point, we can estimate what the estimate might be in 2026, assuming, say, a 2.5% rate of inflation. That being the case, if we assume that in 2026, the annual CPI should average around 330. By comparing the CPI for 2026 with the CPI in the last year that the property was sold, we can get an idea as to what we would expect the asking price to be at a minimum, just based upon inflation alone. For example, if the house was last sold in 2010, we would apply a ratio of 1.51 to the price that it sold for at that time to come up with an inflated estimate for 2026. We'll use a couple of examples to show you how you can apply this. Obviously, I've just got a few CPIs on here. You can go to bls.gov to get the annual CPI for any year going back decades. We'll look next to examples of applying the inflation adjustment ratio, and we'll use the properties that we referenced earlier in the program today. The first property we looked at was asking $389,000. The previous sale for that property in 2014 was $175,000. Now, if we adjust it for the inflation ratio by looking at the inflation ratio for 2026 and dividing it by the inflation ratio of 2014, which we showed previously, the inflation adjustment ratio is 1.39. Multiplying that by 175, we get an adjusted value of $243,250, more than $100,000 less than the current asking price. The other example that we had, the asking price was $405,900, and that had a previous selling price in 2005 of $188,300. Again, the ratio for the period of time there between 2026 and when they sold it in 2005, produced a ratio there of 1.69, which we showed in the chart previously. That produces an inflation-adjusted value of $318,225, which is a little less than $90,000 from the asking price. Now, you'll have to ask yourself, when you apply this approach to whatever property you're looking at, do you want to give the seller that kind of a windfall? Now, if you really like the property and if the market is such that this is the prevailing price and maybe the appraisal supports it, then you may feel more comfortable doing that. But just remember, the day is going to come when you are going to want to sell that property. I'm assuming that this is your first house that you're buying. You're just getting started in home ownership, and this is not your dream home. So 2 or 3 or 4 years from now, you're going to be wanting to sell this property, and be careful what you pay for it, because that's going to influence what you're going to want to get for it when you sell it. So be careful how much you pay to buy the property today. You want the lowest possible price, because that influences your insurance cost, it influences your tax cost, and it even influences your closing costs, because some of your closing costs may be based upon the sale price of the property. So be very careful when you agree to buy something that is clearly way and above what normal inflation adjustment would permit. You have to ask yourself, do you want to really give the seller that kind of a windfall? Well, that concludes our presentation for today. Please tell any friends that you may have that are also considering buying a home in 2026 about this series. We think they'll find this helpful, and we appreciate your support. Please subscribe, and we'll see you next time.